Yeah, I'm losing my edge.
Let's have some fun, though, on Friday afternoon talking about how risky futures are, Mikey. And I don't want to get too existential with this because it depends on, how do you define risk? And we can talk about, just in your daily life, what is a risk? Is it monetary value? Maybe you don't care about money at all. And a risk to you is like missed opportunity in your love life. If you don't go to a certain event and you miss, let's not get too deep into that. Let's keep it within the realm of finance. How do you define risk, Mikey? How do you measure it when you're looking at a potential trade or what have you?
Okay, so two ways. The first is kind of what the traditional financial industry uses when they look at risk, which is volatility on a percentage basis. And the reason we put it into a percent is so you can normalize it across asset classes. So how much does something move up or down on a percent? The other way, which I think is actually more pertinent to everyday traders, is how much is my P&L going to move? So you can take that percent and compare it across products, and it may make something that's small look really big and scary and volatile. But when you look at things in terms of the dollar amount that they move, that's how you determine how much you're going to make on a trade, how much you could potentially lose on that trade. And at the end of the day, that's how I determine my enters and exits on some of these underlying assets.
Absolutely, man. I think that's a great starting place there with the volatility, because we've got a great audience here that knows a lot about stock trading and option trading. And a big question that comes up is the one that we're fielding today when trying to make that jump to futures, which is like these things seem riskier. And today I want to, in a lot of cases, historically, with the traditional futures products that were created decades ago, I would say, yeah, they are a lot riskier for sure. But yeah, I want to first define this risk and then move into what the small exchange has done to try to rein that risk in for the everyday trader. You nailed something right off the bat with volatility. And what we're seeing here is the STIX product, which is the small technology future, 60 different tech stocks, very highly correlated to Nasdaq. And we've got them laid on top of each other here. And you can see that whether you're talking about the STIX futures, the Nasdaq futures, the Nasdaq ETF, the Nasdaq index itself, whatever variation of it, the volatilities are going to be very similar. It's going to be similar movement. You can see here that they tend to rise and fall together. It's not like one being a futures necessarily swings around a whole lot more. And that leads me to what I think, and I got from your statement, Mikey, is the more important piece, which is money. Like, I think that's the way that most people view risk, or in my mind, should view risk in trading, is like, how much money do I stand to make or lose by using this product? And you can see here through that dollar sign lens, the NASDAQ futures is a lot of money here. This is the last 12 months of trading. Mikey, I don't think either of us combined even have enough money to field the risk in this product.
No, and Frank, what is the dollar daily move in NASDAQ? A few $1,000s or something?
Oh, it's well above $1,000. Yes.
Yeah. So if you're new to trading, you could look at this and say, oh, the volatility is 25%. It's the same as the ETF. But then you put on a position and your P&L swings thousands of dollars against you. That's much more than you would expect. So looking at it through the triple dollar sign lens here is a great way to determine which product to trade, especially if you're comparing across, maybe the same asset class, but different type of product like future stock, ETF, option.
Yeah, absolutely. And this is the thing that we've worked so hard to educate people on, which is futures is just a different product type that affords you greater leverage and capital efficiency. Now, where you get into trouble and you start to increase the risk is if you use that leverage to get into a product that's just too big. I mean, the fact that this thing has moved over $100,000 in the last 12 months is just absurd. Like, even no matter how efficient it is with your capital, that is just too risky for the everyday self-directed trader there. That's an institutional product. Now, what we do at the small exchange is we take all the ideas, everything that everybody wants to trade, tech stocks, interest rates, commodities, everything else, and we make it more digestible. And you saw it's the same volatility as the NASDAQ futures or the QQQ ETF shares or what have you. but we've taken that efficiency and made it into a product that instead of swinging $100,000 in the last year of trading, we see something that swings in the last year, the same time frame, about $3,000 or $4,000, which is a lot, but it's similar to 100 shares of a stock that's priced around 50, $60.
Exactly. And you think about the Nasdaq futures, they're moving thousands of dollars a day. You take it to that shorter time frame here with Stick 60, it moves about $80 a day. So significantly more manageable. But what we didn't do when we created this product was remove that opportunity. As we saw in the first slide, it still moves with the same percentage volatility, but we've just pared it down. So if you want to scale up, you can gladly do that. But if you want to stay small around that $80 daily move, that's totally available to you as well. So same opportunity, just a little smaller bite.
Absolutely, Mikey. That's a great piece there. And that's where I want to end here today, which is, you've got a very similar market. Of course, we think that our small technology index is a little bit more innovative. It's got biotechs and all that fun stuff in there, whereas the NASDAQ is top heavy and is mainly Apple, Microsoft, and Amazon. But before, I don't even want to get into that here today. All I want to highlight is that you've got something that moves similar to the NASDAQ here. And it's got the same efficiency of margining. You only have to put up 10 or 20% to trade the product, but it's just smaller than those traditional futures. And thus, I think if you're measuring risk by monetary value, by daily dollar moves, it's a less risky product.